Hello, everybody. This is Debbie Sassen, financial planner and money coach, helping you to build a healthy and confident relationship with your wealth. Now, in last week's video, we talked about three common financial terms: stocks, bonds, and compounded interest. And if you missed those, then I encourage you to go back and check those out. The link is going to be in the comments below. And today we're going to be talking about some more financial concepts that I think it's important, and you've probably heard those. And I'm also going to talk about, a lot of people are hesitant or resistant or even scared to get involved in the financial markets because they're scared of losing their money. And let's talk about if that makes sense. Is that a rational fear or is that an irrational fear? Because we certainly know that over time there have been financial market crashes. There was the great crash of 1929, and most of us probably remember the great financial crash of 2008. And either we were impacted personally, or we have friends or family. Most of us probably know people who really lost money during that financial crash. But let's think about it from where we're standing today, if it really makes sense to fear a financial market crash. And let's think about what is fear actually. Fear is like our worry, our hesitation about something that happened in the past, or it's concerned about something that is likely or potential, or we don't even know could possibly happen in the future. And because of these fears of what has been or what might be, we don't start investing our money in the financial markets. We hesitate and we delay. And just that little bit of delay, as we talked about in last week's video, can profoundly impact the amount of money that you have to take care of yourself in the future. So let me give you a little bit of history. And that is, over the last more than 200 years, the financial markets have experienced ups and downs, but the market has always come back, right? It's taken time. Certainly, the financial market crash of 1929, it took the markets almost 25 years to get back to where they were when they crashed. But because of technology and the speed with which things move nowadays, after 2008, the markets turned around and started rising in 2009, and here we are 9 years later in 2017, and the market has reached new highs after new highs after new highs. And the fact of the matter is that if you're an investor with a long-term horizon, it's actually more damaging for you to be out of the markets when the financial markets are rising than to be in the markets when the financial markets are dropping, right? And let me repeat that because I think it's a really, really important concept for everybody to understand. And that is, if you have a long-term view on your money and on your investments, it's more damaging to your total future wealth to be out of the markets when the markets are rising than to be in the markets when the markets are dropping. Because the idea is that you're going to go into the financial markets and invest on a consistent basis and stay the course and stay invested for the long term. Now, if you are right at the edge of retirement, either right before retirement or right after going out into retirement, that's a situation that we need to look at very carefully and very closely. And in fact, none of this is specific financial advice for your portfolio, but what I would like you to do is to really think about what that means and what the impact is for your portfolio to not be invested and how that impacts your future wealth. Okay, let's move on to two financial terms that are really, really important for most investors to know. You maybe heard them, and that is mutual funds and exchange-traded funds. And exchange-traded funds are also known as ETFs, right? Exchange-traded fund. And what is a fund? We're just going to call them funds for our purposes, whether it's a mutual fund or an exchange-traded fund. A fund is a basket of different investments or a collection of different investments. A fund will hold stocks. A fund can hold bonds, and there are even mutual funds that hold, both stocks and bonds together. Money managers have crafted all sorts of different types of funds to entice the investors to get into the market. But rather than having the responsibility for choosing a single stock or a single bond or your own collection of stocks and bonds, one way to get into the financial markets and invest and immediately have a diversified portfolio is to invest in a mutual fund that already starts with a bunch of different investments in one nice package. Now, let me ask you, if you are really interested, or are you really interested in getting going with your investments? Because, in order to feel more confident investing, in order to ask questions and learn and grow, one way that I really encourage people to do that is to get together with some like-minded friends. It could be an investment group that you have in your local area, or maybe you're going to create your own investment group where you and friends can get together and talk and learn and grow. And there's also a bunch of different financial, groups out there on the internet. Facebook is full of different groups. And a couple of weeks ago, I opened up my own Facebook group called Savvy Money Academy, and that is a safe place for women to get together and ask questions about money management, how to invest, how people are looking at savings, how people are getting out of debt, what people are doing with bookkeeping systems. There's a lot of questions, and when we come together as a community, we can ask, we can feel supported, we can learn, and we can grow without feeling embarrassed. Because this financial stuff that none of us were taught when we were growing up, we feel sometimes a little bit like uncomfortable with it, and we don't know where to turn to get good information. So I encourage you to check out the Savvy Money Academy. You can find me on facebook.com/groups/Savvy Money Academy. I look forward to seeing you there. Thanks so much for tuning in today. Bye.